Another day, another high for the Indian markets. Benchmark indices were largely steady and ended at a fresh closing high, while PSU banks, media and non-banking financial companies advanced. Energy and auto sectors were under pressure. Alex Matthew with a wrap of all the market action.
Well, the Indian equity markets continue to move higher, but there is fatigue evident, and that is evident in the market breadth, which today favored the declines. On the Nifty 50, however, you had more gainers than losers, and we breached the 19,400 mark in trade today. We gave up a little bit of ground to end at just about 19,391, up about 0.33% or thereabouts. Now, if you talk about the primary movers on the benchmark index, then you have to point out three names in particular, and that's Bajaj Finserv, Bajaj Finance, as well as Hero MotoCorp. All of them contributing a lion's share of the gains in trade today. Reliance was a bit of a downer after its smart move yesterday. It lost ground today and proved to be a bit of a drag. The Nifty Bank continued to gain ground, but muted gains. Those gains were driven once again by the PSU banking pack, which gained over 1% in trade today. Financial services were in focus, and I mentioned already Bajaj Finserv as well as Bajaj Finance, but IDFC gained ground. On the other hand, IDFC First Bank lost ground on account of the swap ratio, which is seen to be favoring IDFC Limited. Now, IT stocks were also a bright spot in trade. You saw a little bit of short covering in a few of those names. But I want to talk about two aspects here very clearly. Bajaj Finserv as well as Finance. Finance in particular gained significant ground today on account of a very strong performance in the first quarter. It registered its strongest ever AUM growth in a quarter in the first quarter of this financial year. And then Hero MotoCorp on the one end and Eicher Motors on the other end. Hero MotoCorp ending with gains of over 4% on account of its tie-up with Harley Davidson and the launch of the X440 motorcycle. The premiumization strategy seemed to be benefiting this counter, and that same competition that is inching up or increasing in that premium motorcycle segment is seen to be a negative for Eicher Motors, which was the worst performer on the benchmark index, losing about 6% in trade today. We'll see how that pans out with the launch of Triumph just around the corner, and that, remember, is from the stable of Bajaj Auto. For now, the markets seem to be holding on to the gains that they've made in the recent past, and we continue to breach into new territory. We'll have to see how long that lasts.
While markets continue to scale new heights, will the rally sustain? Which sector should you bet on in this market? Unmesh Sharma shares his insights. Listen in.
One, the two big themes we can see playing out now is stay as much domestic as possible because India is doing great and relative to the rest. The second is that commodity consumers in this environment, because I just talked about what happens in China and globally, and genuinely there is the only risk that you run through the rest of the year is that there is a slowdown in global growth, even though there are no signs of that yet. But you would have seen that in Australia, in Europe a little bit, where recession concerns have come, as in slowdown concerns have come. It could spread to the US. Now, so demand could be where you get negative surprise. But at the flip side of that is that on the commodity consumer side, you could see positive surprise. So we'd rather play margin than demand. Okay. So domestic, play companies which will get demand uplift in the scenario that I'm right, and don't play so much on global demand. So in that context, IT is not an overweight. We are very selective on companies which are specifically targeting niches which we like. So relatively, we now like the mid caps a little bit more than the large caps. Among the large caps, valuations have come off a little bit, so that's good. But we are not very, very positive on the IT space. We are neutral. What we are doing is looking at longer term thematics. We are turning a bit more positive on the consumers, especially the staples, because of the commodity angle. Cement we like as the same result. OMC is within the energy basket we like. And then we like the longer term thematics like gas and financial inclusion like insurance and capital markets. So that's how we are playing this.
Well, IDFC is all set to merge with IDFC First Bank. The board has also announced a share exchange ratio of 155 shares of IDFC First Bank for every 100 shares held in IDFC. BQ Prime's Vishwanath Nair spoke to the IDFC First Bank's MD and CEO V. Vaidyanathan about the rationale behind the swap ratio.
The fact is that every shareholder of IDFC Limited is holding effectively in a see-through way 1.66 shares of IDFC Bank. In this process, they're getting 1.55 shares.
Okay.
How do you arrive at 1.55 shares? There is a valuation process that happens. There's certain cash in the bank there, which I don't think people have seen. That's why we discussed the numbers earlier. And then you go through a process. We, coming to whose favor it is and etc. Our whole endeavor all the time should be how to be fair to our shareholders.
Right.
It is not about how much maximum we can get in any negotiation for that matter. So our intention is how is be fair. It should be fair to IDFC Limited shareholders also. And it should be fair to IDFC Bank shareholders also. So I thought it's a nice midpoint, and we should look ahead. Because if we're sitting today in 2023, do you remember what is the fair price ratio between ICICI Bank and ICICI Limited 15 years ago? Okay. Who knows, right?
Of course.
You just look ahead and you build a bank. Yeah.
With IDFC and IDFC First Bank set to merge, what should investors do? Capital Minds' Deepak Shenoy shares these views.
IDFC shareholders are currently at about a 9% premium. That means if you buy IDFC and then wait for the merger, you'll make 9% if IDFC Bank were to trade at the same point. But that's also because it's about a year away. You're going to go through NCLT, RBI, a bunch of others for permissions. Once all those permissions have been received, it's only then that the merger will happen. I think a large amount of it depends on, so unless you do an arbitrage where you hedge, you buy IDFC short and IDFC Bank, that would give you the merger arbitrage of 9% whenever it happens. So the problem is your capital is locked till that time, so you'll have to keep your capital made available till the actual merger happens. And during this time, the difference can actually widen. We've seen this in Ujjivan. We've seen this in Equitas, where what was 8% became 15% before it went back to zero. I mean, the zero is when the merger actually happens, right? So some of these ratios could also change. Let's say RBI came back and said, you can't do this. You need to give so many more shares or something like that. So they might have to change the merger ratios at some point. So there is some uncertainty around that. So yeah, it's a good investment if you're a merger arbitrage person, if it makes sense for your cost of capital. But 9% is not going to cut it for most people. But on the other hand, is the bank fundamentally a better story or IDFC? I think the story has to come from the core underlying earnings itself. If they can benefit from the growing economy in a better way, if the fear around whatever is happening with Vodafone, because they have some exposure to Vodafone, goes away, I think this bank can actually have good returns in the longer term as well. The returns have been fantastic for the last 1.5 years. So, they have to live up to those expectations in terms of financials as well.
Well, here's an excerpt from the special segment, Ask BQ, post the mega merger of HDFC and HDFC Bank. Chakri Lokpriya answered some questions from investors. Listen in as he answers what an investor can do with their shares.
Question coming in from Ranjana Dikshit via email. Her query is that I have bought 25 shares of HDFC in April 2020. Now, I am looking to sell those shares partly. Would you recommend a part selling? Because the stock has already given good returns.
I think at this point in time, the arbitrage in selling and trying to buy a few days later has largely come down. As we discussed, it's now about less than 0.5%. So unless she wants to book her profits, what she's all done, that's a separate issue. That is clearly a possibility, that is if she wants to book her profits. But in terms of a merger arbitrage, there's hardly any. You will continue holding on your shares and you'll get the new shares.